Welcome to the FNB Financial Monthly Economic and Markets Wrap for March 2024. I'm Jeremy McPhail, Head of Investments for FNB Financial. Virtually all markets were positive for the month, which is a great sign for investors. The only part of the market that was down was volatility, which is a positive sign as well, that momentum generally in markets has been very positive. And it was across all markets across the month, the last quarter, and also the last 12 months now as well. Yeah, so equity markets were generally up 2.5% to 3% domestically, which was around what the markets had done overseas as well, which is good to see for the Australian market that's keeping pace with the rest of the world. Small caps and small companies and emerging companies were the standouts for the month in terms of size of companies. Real estate trusts and technology companies have been the better performers across the month and also the year, with both sectors up sort of 30 to 50% depending on which sector you're looking at. Fixed interest was pretty flat for the month, so relatively conservative returns, which is what you want to see, a bit of stability in that part of the market, which has been quite volatile for a period of time now. Yields began the month and basically finished the month at the same level, which is about 4.1% here and about 4% or 4.2% in the US. As we've been talking about for the last couple of updates, inflation is the core measure that most central bankers and most governments are looking at. Clearly, the cost of living's a concern that people are in front of mind at the moment. And so the central bankers have risen or increased interest rates. It looks like they're now pausing and still watching very closely the inflation data. The expectations of rate cuts are now getting pushed out though. So the data points that are coming through are suggesting that the economies are still performing very strongly. And on that basis, central bankers really probably won't look to move to cut rates until they're confident that inflation's back into normal realms and economic activity or other signals, employment specifically, are starting to ease off a bit. It is a watch and wait at the moment, yes it is. The central bankers are looking at data very closely. There are some that are starting to move. So the Swiss central bank in the month cut rates by 25 basis points to 1.5%. It's unlikely to see anything in the US, certainly until the middle of the year is expectations, although the probability of that expectation of a rate cut in the middle of the year is getting pushed out. So it's less likely that rates will start to be cut sooner rather than later. With the Magnificent Seven, it's already starting to split. Yeah, so we're starting to see that there's differences in returns and differences in outlooks for each of those businesses as well. So Nvidia and Meta platforms have performed relatively well compared to the others. Tesla's lagging, and it's now coming down to individual company fundamentals and the outlooks for each of those. So Nvidia seems to tick all the boxes from the AI lens, that it's got data centers and chips and a few other areas that it's certainly in the right places at this point in time. But there becomes a point in time when valuations start to come to the fore again as well, and so people need to be careful in those sort of sectors and those sort of stocks that they're not paying too much. And at some point in time there will be a tipping point where people say, well, enough is enough, and there'll be a catalyst that will flip investors out of those sorts of securities and into other opportunities that look more appealing. Markets are performing incredibly well at the moment, which is in the face of higher interest rates, which is in the face of probably a slowing consumer as well. So it's not always going to be good times. I always like to think the glass is half full, but valuations are something that come into the fore or the front of people's minds at some point in time. And that may mean where you've seen 30, 50, 80% returns from certain assets, certain sectors of the market, that they may start to ease off a little bit. So it's cautious in some of those sectors. It's not without opportunities as well though. So there's some parts of the economies globally and domestically that still look quite attractive, and so there's still opportunities for deploying money, and that's where we deploy some active managers to consider those opportunities to find those angles to add value in portfolios.